Good evening and welcome to the September 13th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver Kennedy. I'm the founder and executive director of the center, and I thank you so much for joining me for this evening's broadcast. Before we get into the questions from our community, I just want to share a bit with you about the center, then a bit more about office hours, and then we'll go straight into the questions that have come in since our last broadcast. So the Maryland Center for Collegiate Financial Wellness was founded in 2021, and our mission is to help students and families build their financial life skills and empower them to thrive. Our vision is that all college and career school students in the state of Maryland have the chance to achieve these 6 pillars of collegiate financial wellness. Those are being creditworthy, ready, resilient, empowered, successful, and thriving. If you'd like to learn more about the mission and vision of the center and the work that we're doing to achieve this vision, you can visit us online at mccfw.org. Again, that's mccfw.org. And if you'd like to support by subscribing to our newsletter or becoming an event sponsor, please visit mccfw.org/support. And as for Office Hours was launched in December of 2021. It is our free semi-monthly virtual student loan clinic that provides borrowers with a trusted venue to help them navigate student loans and prepare for financial success beyond repayment. Now, before we get into the answers to the questions that have come in, I have to put this disclaimer out here. Office Hours is for informational purposes only and should not be construed as financial or legal advice. We do the best that we can to give you the most up-to-date information available regarding student loans. But if you've been watching Office Hours for a while, you most certainly know that we are in a period of unprecedented changes. So there's a lot going on, many moving parts, and repayment is resuming next month. So we're answering the questions to the best of our ability, but you need to make sure that you take stock of your personal situation, all of your loans, your household income, and other characteristics before you make any decisions. And as for reliable sources, I hope you consider the center as one, but your lender is where you should start. And if you're dealing with federal student loans, that's studentaid.gov. All right, now that we've got that out of the way, let's get into the questions. The first question for this evening is, I heard SAVE is in trouble. What if I sign up and it gets blocked? So that's a good question. There has been a lot of opposition to SAVE, and we've had some movement on that in Congress. And the snippet that I have here pulled from a CNBC article written by Annie Nova gives you just a little bit about that. There's a group of Republicans who are trying to stop President Biden's new, more affordable student loan repayment plan. And they're referring to SAVE, which stands for Saving for a Valuable Education. And I just wanted to give you this quote because everybody's wondering, well, what's going to happen? Is this going to be another Supreme Court issue? That's not the case here. What's happening is Republicans are trying to use the Congressional Review Act to block the new resolutions, but they need this. They need for this to be something that's agreed upon in both chambers, the House and the Senate. And even if both chambers agree, the president has the power to veto the resolution. And since this was President Biden's new, more affordable student loan repayment plan, I'm pretty sure that if the resolution, even if it did succeed to make it through the House and the Senate, once it lands on his desk, he will veto it. So SAVE is here to stay for as far as I can see. I will definitely be paying attention so that I can keep you posted. But just remember, the implementation of SAVE was far different from the attempted implementation of that broad cancellation plan. The broad plan that the Biden administration introduced last year in August was the plan that would have given up to $20,000 in debt relief per eligible borrower. That was something that came from the president. That did not go through a rulemaking process. That was very much like an executive action that approached a broad cancellation. As such, it was contested. The lawsuits made it all the way up to the Supreme Court. The Supreme Court ultimately ruled to block it. SAVE is different. SAVE is a new, improved version of an existing repayment plan that went through a more collaborative process to create it and get approval to implement it. So this is not something that will play out like the Biden-Harris Student Debt Relief Plan did earlier this year. So if you're worried about SAVE, I think we can say with confidence that it's going to be around. And if you were to apply for SAVE and it did disappear for some reason, I'm not sure what would happen. Remember that SAVE is an updated version of Repay. So if SAVE were not to make it, perhaps you'd be put back into Repay. But I honestly cannot say what would happen in that scenario because it hasn't happened, and I won't know until it does happen. However, I don't think it will happen. I know that's very confusing, but all of that to say, I think it's safe to go ahead and apply for SAVE if that's the direction that you're leaning in. All right, another question about SAVE. This question comes straight from a borrower who said, I'm enrolled in PAYE, should I switch to SAVE? Quick note on the acronyms here. PAYE stands for Pay As You Earn, and that's an income-driven repayment plan. SAVE, of course, is the new, more affordable repayment plan. It stands for Saving for a Valuable saving on a valuable education. Please don't quote me on that for or on, but SAVE is the new and improved version of Repay. So had to ask some questions of this borrower to get down to an answer that I thought was a pretty good one. As for the borrower's background, most of these inquiries prompt me to look at a person's loan types because that's where you can really find out what kind of benefits or repayment plans a person is able to access. So starting with the loan types, I was able to see this borrower has undergraduate and graduate loans, and they have no Parent Plus loans. All the loans are their own. In terms of public service loan forgiveness, they are at about the 60-month mark, 60 qualifying payments for PSLF, so that puts them as halfway through the process. Their loans are already with Mohila. They've been working in this nonprofit space for a nice amount of time. And again, halfway to PSLF. And they also have a family size of 1. So before making the decision about whether to leave PAYE and go to SAVE, I just went through a few things with the borrower. One is the formula for the payments. SAVE and PAYE are similar in that they're income-driven repayment plans. They use a percentage of a borrower's discretionary income and treat it as available for student loan payments. Pay As You Earn uses 10% of the discretionary income. SAVE uses 5%, or it will use 5% for undergraduate loans, 10% for graduate loans, and for people who have both undergraduate and graduate school loans, it'll be a weighted average between 5 and 10%. So they're both using a percentage of the discretionary income, but with SAVE, if a person had undergraduate loans only, that percentage of their discretionary income could go down from 10 to 5%, so cutting it in half. And notice that part about the 5% will not be implemented until next July. The second thing I wanted to look at is the income that's protected by each of these repayment plans. With Pay As You Earn, the formula looks at your adjusted gross income and compares it to 150% of federal poverty guidelines for a household the same size as yours in your state of residence. So that 150% of the poverty guideline is what we call protected income. PAYE protects 150%. SAVE protects 225%. And if more income is protected, that means that the payment will be lower. That part of SAVE is supposed to be implemented this year. The next item is, how long does it take for loans to be canceled by way of Pay As You Earn versus SAVE? For Pay As You Earn, the forgiveness or cancellation milestone is 20 years in repayment, regardless of whether you have undergraduate loans or graduate school loans. When it comes to SAVE, if all you have are undergraduate loans, then the milestone is 20 years. If you have graduate school loans or a combination of undergraduate and graduate school loans, then that milestone jumps up to 25 years. And that was the one that really stuck out to this borrower the most. Lastly is the interest subsidy. This is also a big one. So with Pay As You Earn, there's an interest subsidy on subsidized loans only for the first 3 years of repayment, 3 consecutive years of repayment. When it comes to SAVE, the interest subsidy is supposed to cover all interest that is not covered by the borrower's required payment. So if you had a required payment of $50 per month, but the interest accruing on your loans amounts to $100 per month, that means each month you wouldn't be covering an extra $50 of interest. And you continue to make your payments month after month, but you see your balance continue to rise because of that unpaid interest. What SAVE is going to do is eliminate that unpaid interest, and that the government is going to cover it. So this is a really big deal that will help a lot of people who are dealing with or might begin to deal with negative amortization. Now, remember, this borrower is going for PSLF. So what we're seeing here about the 20 years versus 25 years, in a perfect world, none of that will matter, because with PSLF, this borrower should be done in 5 years. So when we talk through the decision about whether to switch from pay to save, we landed on they should apply for SAVE, because the goal is public service loan forgiveness. The part about the interest subsidy isn't as important, because we're looking at a 10-year timeline, because public service is involved. The 20 versus 25 years doesn't matter, because we're looking at PSLF. However, I did mention that if they were thinking about changing careers, then they might want to stay in pay as you earn, just because that would keep all of the loans on a 20-year milestone instead of bumping it up to 25. But this borrower is committed to staying in the nonprofit space. And if that's the case, the most important thing to the borrower is basically to pay the least amount overall. And the least amount overall would be paid by getting on track for SAVE, because the income protection is higher, and there's potential for that percentage of discretionary income to decrease, because they'll be using a weighted average between 5 and 10% based on the amounts borrowed for their undergraduate and graduate loans. So if you're thinking about leaving pay as you earn and heading over to SAVE, you have a lot to consider. But for people who are going for public service loan forgiveness, again, your goal is really to pay the least amount over time. So if you have the opportunity to enroll in a cheaper plan, and you know that public service is what you're sticking to, then SAVE is the plan that will help you achieve that goal of paying the lowest amount overall. All right, so we're moving to a state-specific question, and the question is it too late to apply for the Maryland Student Loan Debt Relief Tax Credit? This is debt tax relief credit. Do you have to have gone to a certain school? So 2 questions here. One is about the deadline. The other is about the availability of the credit to people who went to certain schools. So let's take a look at the application's requirements. By the time this video makes it to YouTube, I'm pretty sure it'll be too late for you to apply because today is September 13th, and the application must be submitted by September the 15th at 11:59 p.m. As for the requirements, first and foremost, you need to examine the amount of student loan debt you borrowed and how much you have remaining to determine if you're eligible. You must have borrowed at least $20,000 and currently owe at least $5,000. And the loans must be for your own education. Beyond that, you have to provide some documentation, and I just wanted to share with you the documentation you need and where you can find it, as well as when you need it. So the first thing you'll need is proof of your student loans, and you will need that to submit that with your application before 11:59 p.m. Eastern Time on September the 15th. You can find that information within your servicer's online portal, and the state is very specific about the type of information that needs to be included in the proof of loans, and we'll talk about that in a couple of slides. The next thing you need is a copy of your state tax return, which is Maryland Form 502. You want to submit that with your application. Where to find it? Your personal records. You also need to submit transcripts from the schools you attended when you borrowed the loans that you're going to include in your application. So if you went to, let's say you went to 3 schools, one of the schools you did not take out loans, then you don't need a transcript for that particular school. And I know sometimes when people see transcripts, they think, oh my goodness, I have to get official ones. So do I have to go up to the school and get something printed or use an online portal and wait for a third party provider to send it to me in 2 weeks? You don't have to do that. You can get an unofficial transcript. So if you already have one around, that's fine. If you can go into a school portal and download an unofficial transcript, that's okay. But you need to submit your transcripts from the schools that you attended when you borrowed the loans. The last thing you need, and this comes later on, is to submit proof that you've made student loan payments after you received the credit. And you have to prove that you paid at least the amount of the tax credit you received towards your student loans. The good news is you have 3 years after the close of the taxable year for which the credit applies. So you don't have to use the credit right away, but you have to provide proof to the state through the Maryland Higher Education Commission that you did indeed take the same amount that you received via the tax credit and put that towards paying your student loans. So that's the documentation that you need. Now, the tax credit, Maryland Student Loan Debt Relief Tax Credit has been around for several years, but there have been some changes implemented recently. One of those changes is that priority is going to be given to state of Maryland employees. So within the application, they're going to ask you, do you work for the state? There's also priority that's going to be assigned to graduates of certain schools. Those include several community colleges, all of the state's HBCUs, and a couple of four-year institutions, additional four-year institutions in there. So priority is going to be given first to state employees and then to graduates of the schools that are on this list. It doesn't mean that you are not eligible if you graduated from another school. It just means that priority will be assigned to people who graduated from the schools on this list. Another level of priority, and this is something, it's not a change, it's been like this for a while. Priority is also given to people who have not received this tax credit in a prior year. So if this is your first time applying and you work for the state and you graduated from one of these schools, I would think you have pretty good chances. But I just wanted to share with you how they're going to go about divvying up these funds, because there's a set amount of funding, but there's always excess demand. So there are more people demanding or who want to have the credit relative to the amount of money there is to distribute for the credit. So they've got some different levels of priority assigned, and those are listed here. As for the application itself, it's available online at onestopmd.gov. You can upload all of your documentation there. You just want to make sure that you get that application completed by 11:59 p.m. on September the 15th. So as of tonight, you got a bit more than 48 hours to get it done. And this tax credit, it comes about every year. The application is released in July. The deadline is always September the 15th. All right. So I just wanted to share with you some tips for submitting a successful application. The first one has to do with questions 1 and 2, and that's to make sure that your loan amounts are matching. There's a question about how much you originally borrowed, and there's another question about how much you owe. Those items should be viewable in the documentation that you submit about your loan. So you want to make sure that the documentation you're submitting has loan amounts that match your answers to questions number 1 and 2. Second, you want to make sure that your documentation is sufficient. The format that the state has asked for is PDF. They have been very specific in saying that Word and Excel files are not acceptable because they can be edited or altered. Also, they mentioned Fed loan and AES, that detailed statements from those two servicers are not acceptable. I think Fed loan is not in the business anymore, but either way, they specifically called out those two servicers and said that the detailed statements are not acceptable documentation for loans. And if you are uncertain at all about the documentation required, you can go to onestop.md.gov and take a look at the details about what that documentation needs to have, what's acceptable and what isn't. Next, let's move on to your proof of loans. The proof of loans must include your lender's name, the address, and their phone number. It also needs to have your name and your account numbers. You should also have viewable your original loan balances, your current outstanding loan balances due. Lastly, your transcript. I noticed there was a new request, and that was that on your transcript, you somehow need to mark the name of your degree and the date it was earned. That could be by circling, underlining, maybe an asterisk, I don't know, but some type of mark on the name of your degree and the date that it was earned. So to answer the question, it is not too late to apply as of right now, 7:21 p.m. on September 13th, 2023. But you must get the application in by 11:59 p.m. on September the 15th. All right, next question. This one goes back to PSLF. It feels like everyone is getting their loans forgiven but me. I applied for PSLF and I've worked in public service for 20 years. What's going on? This is a common question and a loaded answer, but I'm going to stick to this particular borrower situation here. So with this borrower, I always want to start off with studentaid.gov. With this borrower, it was very tempting to just go to mohila.com because the borrower mentioned they had already applied for PSLF. But I like to start off with studentaid.gov so that we can make sure that all loans are covered, especially since we are coming out of this 3.5-year payment pause. It's very important to get a full picture of all of your loans. So we started off at studentaid.gov to verify that all the loans were held with Mohila. Then we went to Mohila to verify their existing qualifying payment count. We were able to find that the borrower had 86 qualifying payments. For PSLF, that magic number is 120. So with 86 qualifying, that means that the borrower had 34 to go. And with a public service career spanning 20 years, it just didn't make any sense. So we looked at that eligible number. The eligible payments are at 148, well over the 120 that are required to be approved for PSLF. So when you see a big difference between the eligible and qualifying payments, that lets you know that there's probably some missing employment that needs to be verified, especially for someone who's been working in public service for their entire career. So my recommendation was, let's check those prior employment verifications. So there are two ways to get there. We went the first route, which was on the payment count where you see qualifying and eligible. There's a spot, it's either there or with the goalpost screen where they have 120 in the middle. There's a link that says show payment summary. And when you take a look at the payment summary, this gives you a month by month listing of which months have been found to qualify versus those that have employment not certified. So we went and we looked and we saw that there was like, I don't know if it was a 7-year period, it could have been 7 years, but it was just a very long time, maybe 6 or 7 years where there was no employment verified. And it didn't make sense because the borrower has worked for a school system for 20 years. The other thing you can do to check this is on the payment tracker. When you get to the payment tracker on Mohila's website and scroll down beyond the text, you should see 4 blue like rectangular tabs. The fourth one, the last one on the right, says employers. And if you click on employers, you can see a list of the employers that Mohila has certified your employment for, and it will show you the time period for which the employment has been certified. So we were able to find, several years of payments for periods that could count if the employment was certified. And this led to some more questions for the borrower. So we had to wonder why, if you got 20 years, with the same school system, why is it that this count looks the way that it does? And it turns out the borrower does have, the same employer, has had the same employer for more than 15 years, but there was a period where the borrower had left and there was basically a 1-year gap in employment. And since there was a gap in the employment, when the borrower submitted the PSLF application before, it was based on their second employment stint. So let me scroll back to this other screen. The 86 qualifying payments, those were based on the second employment stint after that 1 year gap. Everything prior to the stint had not been counted. That's why we saw that big difference between the eligible payments and the qualifying payments. So all this borrower needed to do was to submit a new PSLF application that included the first stint of employment for the same employer. So they went ahead and completed that on the PSLF help tool, used electronic signature for verification, and hopefully we will hear some good news from this borrower in the coming weeks. All right. Well, actually, before I move on to the next question, I just wanted to say that when it comes to PSLF and loan forgiveness in general, I know that for people who work in public service, you're probably seeing more people around you experience success with PSLF because, the word is spreading, people are applying, and approvals are coming through. And I know that it's very it's normal, to look around and wonder, well, we've been here for the same amount of time. Why isn't my application going through? What I want you to remember is that everyone's journey is different, especially when it comes to student loans. Everyone's journey to borrowing is different. Everyone's journey to the zero balance is different. And a little something that strays a bit out of the student loan space is just that comparison can be a thief of joy. And I know that, like I said, it's normal, it's valid to have those questions. It's also good to investigate your situation to find out why your loans have not been forgiven yet, or why you have not been extended a benefit that someone else may have been extended. You definitely want to investigate and follow up, just like this borrower, to make sure that everything is accounted for. But an easy way to take yourself down a path that is not one of wellness is to look around and keep comparing your situation to everyone else's. So do your best to focus on your own situation. Make sure you completed all of your applications and that you're doing everything to get on track for PSLF and stay on track for PSLF, and stay the course. If you've done everything you're supposed to do, the victory will come for you as well. But just remember, everyone's journey is different. Your situation is not going to look the same as everyone else's, and your experience with MOHELA will certainly not be the same as anyone else's. And I mean that in the nicest way possible. All right, let's move on to our next question. I have loans from the 90s and loans from the 2010s. I don't want to consolidate because I'm earning more money than when I certified before. Do I need to consolidate right now? So at the core of this question is the person has a $0 payment and they don't want to recertify because they're earning a lot more money and they're concerned that that $0 payment is going to go away. So as with every other case, I had to do some background. Oh, pardon me, I think I got the wrong slide in there. Sorry about that. I had to get some background. We'll talk about that in just a little bit. But I wanted to talk to you about consolidation and the difference between consolidating before the IDR adjustment and before the limited waiver versus during this adjustment, because this person has these loans with a significant gap, some from the 90s, some from like 2015 and beyond. So right now, those sets of loans are on completely different paths for cancellation. And if this person wants to get the fastest path possible for all the loans, consolidation would definitely be the best move, because it would take those loans from 2015 and beyond, and it would put them on the same repayment clock as the loans that were borrowed in the 90s. So on the left-hand side, you see before the adjustment, we're assuming a person had a direct loan like this person with about 33 months of history, as well as a FFELP consolidation loan with about 160 months of history. If those loans were consolidated prior to the adjustment, the old rules would have seen this person start off with a new direct consolidation loan with 0 months of credit for their past repayment history. So in terms of PSLF or even cancellation by way of income-driven repayment, they would be starting fresh with a new repayment term. Now, during the limited waiver and the IDR adjustment, there's a huge benefit to consolidating loans that have differing lengths of repayment history. That 33-month loan and the 160-month loan, once combined, will be credited for the full 160 months. And if those 160 months took place after October 1st of 2007, and the person was working for a qualifying employer during that time, then this person would already have more than enough credit for PSLF. Now, when completing the online consolidation application, there's a section where you have to apply for a select a repayment plan. So we actually got started doing the application, and we got to the place where it was time to grant permission for Ed to pull information from their tax transcript via the IRS. The borrower said, hey, slow down. Not quite ready for this, because right now I'm on a zero payment, and now I'm making more, and I don't want the zero payment to go away. So I completely understand that concern. So I tried to give the borrower a holistic view of the situation. We already know that consolidation is the best way to get these loans on the fastest track to forgiveness by way of PSLF. But we also have the IDR adjustment going on. And from what I saw, I think all of these loans are actually direct. It's not a FFELP loan. They're all actually direct. And since they're direct, they're going to be included in the IDR adjustment with no application or anything necessary. That's just going to happen because the loans are direct. So the first thing we need to really think about is the history of the older loans. Could they be so old that they actually end up being canceled during the IDR adjustment? And if the answer is yes, and let's suppose this person has reached, the 20 or 25-year milestone already, those loans could get canceled in the next wave of the IDR adjustment, which might be next month. I think it's every other month. The first wave was in August, so I'd expect another one would happen in October unless the Department of Education has issued word of a different schedule. So if these older loans were to get canceled next month, then the borrower would no longer have the opportunity to take the more recent loans and combine them with the older loans to get everything on that fast track to forgiveness. And if that happens, that means the more recent loans are going to face a longer road to cancellation. So that history is a good thing because it can help more recent loans get to loan forgiveness faster. But that only happens if you consolidate. And that's also if you apply to consolidate by the end of this year. The other thing we had to think about is really how much more would the payment be? Right now, the borrower has a zero payment. I believe they're enrolled in revised pay as you earn. If they were to get switched to Save has a higher income protection. So remember, we were talking before about the 150% poverty line that's used in pay as you earn. In repay, Save has an income protection of 225% of that poverty guideline. Also, next summer, that cut in discretionary income, that percentage of discretionary income that's viewed as available for repayment, that cut is going to take place next summer. So instead of 10% of discretionary income being taken, it would be 5 to 10% because this borrower has both undergraduate and graduate loans. The other thing is that even if reporting the higher income is avoided right now because they decided to delay the consolidation application, it's going to catch up because income-driven repayment plans require you to recertify, and that process takes place every year. So eventually the higher income is going to come. But if the payment right now is zero, I just had to think, well, what could it possibly be? But in this situation, the borrower did not want to proceed with the application to even see how much it would be. They just decided to pause. So what we settled on first was trying to estimate the repayment history. And here I want to give a shout out to Stanley Tate. He's an attorney, and he and his team have developed a text tool that allows you to upload your student aid file. And if you've ever downloaded that student aid text file and tried to read it, I'm sure you're just like, what in the world am I looking at? It's a lot of information, and the way that it is presented makes it a bit challenging to try and identify, the length of relevant repayment history for every single loan you borrowed. So this tool that Stanley Tate has had built, it takes that file that, in its raw form, we really can't do much with, and it translates it into this, or transforms it, I should say, into this very aesthetically pleasing and easy to understand format where you can see the length of repayment history estimated for each loan. You can see which loans are open, which ones are closed. You can also take a look at the status history. So it's just a much more user-friendly output. I also want to say this is not an ad. I don't have any kind of partnership or referral relationship with Stanley Tate. I just saw the tool and used it with the borrower, and it was just very useful in being able to estimate that repayment history and not trying to have to sift through that student aid text file. So if you're interested, you can visit Stanley Tate online, and it's the student aid text tool on his website. And if you're okay with sharing that text file, there is a warning on studentaid.gov that says there is personally identifying information in the file. Some people don't want to share that, and I completely understand that. But if you would like to use the text tool, you can visit him online, and I'll make sure to drop a link to his website in the comments once this video makes it to YouTube, in case you're interested in exploring. But again, no referral relationship, nothing like that. It's just a tool that I used with a couple of borrowers in recent weeks, and it provided very useful output. So based on the repayment history that we saw, the borrower decided to postpone their consolidation application and revisit it by year end. They're definitely going to look at SAVE, because with their increased income, SAVE has that more affordable formula. So perhaps SAVE could bring it back down if it does increase significantly because of their new income. So lots to think about. The big thing I want everyone to remember is that it's totally your decision. Everybody's situation is different. There are several factors that need to be considered, but it's your decision about what you do next. Okay. Next question is about SAVE again. It says, I looked at my servicer's website and it says I'm enrolled in SAVE. I have Parent Plus loans. How is that possible? Well, I wondered the same thing when I was looking at this borrower's account, because the borrower logged in and I saw SAVE on the account homepage. And I said, that's a little strange, because I know that there are Parent Plus loans involved here. So again, going into the account home, the first, the main page that shows the overall balance lists their repayment plan as SAVE. But if you drill down into the loan detail and go loan by loan, then you can see that the person had unsubsidized loans for their own education that are now enrolled in SAVE because they were in repay and they were switched over to SAVE, and their direct Parent Plus loans were in a standard plan. This makes sense because Parent Plus loans are not eligible to be enrolled in the SAVE plan. But I just wanted to share that if you were to look at the account homepage and search for your repayment plan, and you saw SAVE and you just stopped right there, you'd be under the impression that all of your loans were enrolled in SAVE. And this borrower's situation shows that that's not the case. You have to dig deeper. So beyond that initial account homepage, you want to go loan by loan and look at the repayment plan that you're enrolled in, as well as the dollar amount of the payment. So since this person has Parent Plus loans for their child's education and unsubsidized loans for their own education, they're going to pursue the double consolidation loophole. This will allow them to have access to more affordable repayment plans for their Parent Plus loans. So they've completed the paper application to consolidate their Parent Plus loans. And after the consolidation loan of the Parent Plus loans has dispersed, they're going to take that consolidation loan and consolidate it with their direct unsubsidized loans. And the end result will be a consolidation loan that will now have access to more income-driven repayment plans. Parent Plus loans are their only income-driven repayment option is ICR, which stands for Income Contingent Repayment. And some parents choose to pursue this double consolidation loophole so that they can have access to a more affordable payment. ICR, there are two ways to calculate it, but the first way is 20% of your discretionary income. With repay, and pay as you earn, it's 10%. So for a parent, they're looking at the possibility of cutting their payments in half. And for them, that possibility is enough to explore this double consolidation loophole. So what we settled on was they're moving forward with that double consolidation, but also contacting their servicer, which is Mohila, to ask about the most affordable repayment plan for Parent Plus loans in the meantime. And the borrower did let me know they reached out to ask about that. We're told that since they were consolidating, the loans would be put into a forbearance while the consolidation loan was being processed. So that was also an interesting development. Okay, so at this point, I want to shift gears and focus on repayment. Repayment is upon us. Interest has already started to accrue. Payments will resume next month. So there are a few things that you can do if you have not done so already to get ready. First, log into studentaid.gov so that you can get a full inventory of your loans and get the contact information for your servicers. Take a look at the repayment plan that you are currently enrolled in and just ask yourself, is the payment affordable? To see the actual payment, I think you'll need to go to your servicer's website. But you can get the information about your servicer from studentaid.gov, go to the servicer's website and find out the payment plan you're on if the amount is feasible for you. You also want to make sure that your contact information within studentaid.gov is up to date. And for every servicer that you have, you want to do the same thing. Make sure that they have up-to-date contact information for you. If you have commercially held loans, then next month will be likely the first time in a long time that you will have to make payments on both the commercially held loans and the federally held loans. So it's time to have two payments again. You might want to consider consolidating to benefit from the IDR adjustment, which will put those different loans on the same clock in terms of gaining credit toward income-driven repayment cancellation or public service loan forgiveness. So it's something to think about. It's not for everyone, but it's definitely worth exploring, and the greatest benefits will be reaped by those who complete that application to consolidate by December 31st of this year. All right. So getting a lot of complaints right now about the experience with servicers, but a lot of it has to do with the amounts that people are seeing is due. When they log into their servicer accounts, they're seeing some numbers that are really, really high, and they're wondering what's going on. Many of them have contacted the servicer and the payments were updated, so you might want to do that too. But if you have other issues, there are definitely more options for accountability. I always like to share the Consumer Financial Protection Bureau. You can visit them online at consumerfinance.gov. The U.S. Department of Education also has an ombudsman. You can go to their website and find out if the issue that you're having falls under their purview. And if you have a specific issue with public service loan forgiveness in your payment account, you can submit a PSLF reconsideration request to get that evaluated again, and perhaps you'll get a different result. At the state level, Maryland does have a student loan ombudsman through the State's Department of Labor. The student loan ombudsman assists with problems that you might be having with your student loan servicer, and those problems can include failure by the servicer to communicate with the borrower, errors in crediting principal and interest payments, misapplied payments, inaccurate interest rate calculations, billing errors, loan consolidation or modification errors, and or inappropriate collection activity or tactics. As for the Maryland Student Loan Ombudsman, if you are currently in repayment and have a complaint about your student loan servicer, you can visit the Ombudsman online at the Department of Labor's website. You can also see the Maryland Student Loan Borrower's Bill of Rights to learn more about the protections to which you are entitled to as a Maryland borrower. And both of those things there are listed for the Ombudsman through the state's Department of Labor. All right. At this time, I want to thank you so much for joining me for this edition of Office Hours on September the 13th. My name is Dr. Tisa Silver Kennedy. I'm the founder and executive director of the Maryland Center for Collegiate Financial Wellness. You can visit us online at mccfw.org, and you can connect with us across all social media, well, many social media platforms. We are on Facebook, Twitter, Instagram, and YouTube at the MCCFW. So please do reach out, engage with us online, and we're happy to have you as a part of our community. All right, so I'm going to stop sharing my slides at this point and take a look at the comments to see if we have anything there. I don't see any on Facebook. All right, so it looks like things are quiet for now. I also wanted to mention an experience with a borrower who is applying for public service loan forgiveness and experiencing difficulty with getting the employment verification obtained from their employer. Sometimes employers will refuse to use DocuSign. They might have outsourced their employment verification to a third party, and that makes it difficult when DocuSign is involved. Had another instance in which the email address for the like a blanket HR verification address within an organization would not fit for some reason in the employer email address slot for electronic signature within the PSLF help tool. And that's kind of strange, but it's something that can happen. So I would urge you to check with your employer before you submit the form, so that you don't run into a situation where you have submitted a form electronically to some random inbox, or you have submitted something to a non-working email address, or a person who doesn't work there anymore, or to a person who doesn't know, per organizational policy, that they're allowed to complete that form via DocuSign. So check with either your manager, human resources, or payroll before you send them that electronic document for verification, because they have 60 days to respond. You don't want to have this sitting out there for 2 months because someone, hasn't been authorized to use DocuSign to sign the form, or it doesn't actually reach them because it went somewhere else. So it's good to check that process with your employer first. Another thing about PSLF, I've been asked this a couple of times. Some people are submitting PSLF applications for employers that no longer are operating. And if that's the case, there is an option to self-certify on the PSLF application. There's a question that asks you if you are unable to get the form certified, either because the organization is closed or they're refusing to certify. You can click the answer that yes, you need to self-certify because there's no one to do it for you. You definitely want to provide some documentation. It could be W-2s. That's the most common documentation I've heard of. But you'd have to provide your own documentation that you did indeed work there. But self-certification is a possibility. Another question that has come up is, what if I go to the PSLF help tool, the studentaid.gov/PSLF, and I see that the status from my employer is undetermined? My view is that anything that you see other than ineligible is up for grabs. So if it says undetermined, then that means that you might need to provide some documentation to prove that the organization is a 501c3 nonprofit organization, or that they provide qualifying services for the general public. You basically need to make the case. And if you are able to successfully make that case, then the employer can convert from undetermined to eligible. And that means that everyone else who comes after you, who's applying for PSLF based on work experience for that organization, their applications will make it through faster because you made the case and caused the search result in the database to change, because now it's been documented that the employer indeed qualifies for PSLF. All right, I'm going to pause once more and take a look to see if we have anything in the comments on Facebook. I don't see anything. Trying to think of any other common questions that have come about. General PSLF processing update. There are several people that I've worked with earlier, prior to the summer, I'd say like maybe April-ish, who are still waiting to hear results. I know one person in particular went like 6 months recently and didn't have any update on the application. And their loans were moved from their existing servicer over to Mohila. So we know that their employer, has been verified as qualifying. But when they log into mohila.com and go to that PSLF menu, the payment tracker is not an option for them. So they can't see, what their payment count is. And it's been like 6 months. So I advise them to reach out to Mohila, ask for an update. They received an update recently that said that they would get a response with a more accurate payment count within, I believe, 14 business days. They basically said they were going to go back and review the prior application that had been received, but somehow the payment count had not been updated. So hopefully within that period, we will hear some success from that borrower, because this one is a person who, when we started the application more than 6 months ago, based on their employment history and their repayment history and the standard processing time, we thought that this debt would be a thing of the past by now, and that repayment would not have been an issue because they had that much history. But something happened with the processing. I can't remember if it was a duplicate form and neither form was fully processed after it being labeled as a duplicate. Whatever it is, it's been sitting for about 6 months and we're waiting for an update. So hopefully we'll hear something soon. Check the comments one more time. I don't see anything. It's always a good time to thank you all for joining me for office hours, and to just make sure that you connect with us on social media. You can like or follow us on Instagram, Twitter, and Facebook at the MCCFW. And you can also subscribe to our YouTube channel. We are at the MCCFW, the Maryland Center for Collegiate Financial Wellness, on YouTube. So this is the September 13th edition of Office Hours. By the end of the week, we should have this video uploaded to YouTube, and we will annotate it so that people can get straight to the questions that they are looking to have answered. And if you have any questions in between our office hours broadcast, you can go to mccfw.org/contact and submit your question. We will do our best to get back to you, but I have to say, this is a hectic time. Repayment is coming back after, a good 3.5 years of not having to make payments. And now, not only emerging from the pause, but having this revised payment plan, also having an on-ramp, having the IDR adjustment, having gone through a transition in the number of servicers that are out there. There's just a lot of things happening at the same time, and we're getting a lot of inquiries. So I'll do one more check of the comments, and I don't see anything. So at this point, I'm going to go ahead and sign off. I want to thank you again for joining me for this edition of Office Hours. Thanks to everyone who has supported the Maryland Center for Collegiate Financial Wellness. We are looking forward to the next edition of Office Hours, which will be on September the 27th at 7 p.m. Eastern Time. Like I said, if you have any questions, comments in the meantime, please feel free to reach out to us at mccfw.org/contact. And if you're on YouTube and have a question, just drop it in the comments. We will do our best to get back to you as soon as possible. Until next time, be well.